JEPI's crushed BKLN with double the returns, but we're about to uncover some costs that might change your mind completely. JEPI's 60% 5-year return doubles BKLN's performance. That's what winning in the income fund space looks like. But here's where it gets interesting. BKLN's 29% 5-year return is underwhelming. That's barely keeping pace with inflation, let alone building real wealth for investors. In plain English, JEPI absolutely smoked BKLN over 5 years, lapping it twice like a turbocharged race car blowing past a commuter sedan. Speed versus fuel efficiency? Speed won by a mile. Now, let's shift gears and look at JEPI's 34% 3-year return shows. It's not just a flash in the pan. Consistency matters when you're building real wealth. Here's where the story takes a turn. BKLN's 27% 3-year return is solid, but it's clearly lagging behind whatever benchmark we're comparing it to here. Let's break this down further. JEPI delivered 9% returns over 12 months. Solid performance that extends across shorter time frames too, maintaining consistent advantage. But here's where it gets interesting. BKLN's 7% 1-year return shows steady performance. Not flashy, but consistent gains you can actually count on here. In plain English, JEPI's like that rare runner who wins every distance. Sprint, 5K, marathon, you name it. BKLN? Reliable finisher, sure, but you won't see it on the podium. Let's dig into the details. High returns mean nothing if you're risking everything to get them. Risk-adjusted metrics show who's actually earning their gains efficiently. Here's where things get revealing. JEPI's Sharpe ratio of 0.6 means it's delivering decent risk-adjusted returns. Not spectacular, but solid enough for income-focused investors. Now, let's put this in perspective. BKLN's 0.3 Sharpe ratio shows half JEPI's risk-adjusted efficiency. You're getting weaker returns for every unit of risk taken here. In plain English, think of the Sharpe ratio like mechanical leverage. JEPI turns each dollar of risk into twice the returns BKLN generates. Better leverage means better outcomes for your portfolio. Here's the thing, though. A Sharpe ratio of 1.3 over 3 years shows BKLN's delivering excellent returns without taking on excessive risk. That's what matters. Let's take a closer look. JEPI's 3-year Sharpe of 0.7 is solid, but BKLN nearly doubled it. Better risk-adjusted returns mean more bang for your volatility buck. Now here's where it gets tricky. JEPI's stronger Sortino ratio shows it delivers better returns per unit of downside risk, exactly what income investors want to see. In plain English, the Sortino ratio is like storm brewing. It only counts the bad weather days. JEPI's weathered storms better over 5 years, but BKLN's catching up recently. Let's see how this plays out. BKLN's 1.4 Sortino ratio shows you're getting rewarded well for the downside risk you're taking. Strong risk-adjusted performance here. Here's what really matters. JEPI's Sortino of 0.8 matches the comparison, but BKLN takes the crown for better downside protection over 3 years. Now let's connect the dots. Risk-adjusted returns tell a different story. JEPI wins the long game, while BKLN takes the short-term crown. Your timeline matters here. In plain English, same funds, different stories depending on your timeline. JEPI shines over 5 years, while BKLN's strength shows up in that 3-year window. It's like a seesaw. Where you sit changes everything. Let's unpack this a bit. All right, who's taking this show down? Let me know your pick in the comments below. Here's the key takeaway. Maximum drawdown reveals your peak-to-trough pain, while recovery days measure how long you're stuck waiting to break even again. Now let's flip the script. JEPI's worst drawdown hit negative 14%. Not bad compared to most equity funds that dive much deeper during market crashes. But there's a catch. BKLN's worst 5-year drop was just 7%, half the drawdown pain you'd feel with JEPI in tough times. In plain English, maximum drawdown shows the deepest loss from peak to trough. Think of it like a swimming pool. JEPI drains to 14 feet, BKLN just 7. Both refill, but that deeper drop really tests your nerves. Here's where the story takes a turn. Nearly 9 months underwater before breaking even, that's 258 days of testing your patience while other investments moved forward. But here's where it gets interesting. BKLN bounced back in just 224 days, proving that smaller wounds heal faster when the market rebounds. In plain English, think of recovery time like a marathon runner after a fall. JEPI stumbles harder and takes way longer to get back to race pace, while BKLN trips but bounces back quicker. BKLN's smaller crashes and faster recoveries make it the safer bet, while JEPI trades higher returns for steeper downside risk. Here's where the story takes a turn. For income investors, what matters most is yield. That's what determines how much cash you're getting every month. Let's break this down further. JEPI's 8% yield means steady monthly income. That's real cash flow hitting your account every single month like clockwork. Let's break this down further. BKLN delivers a solid 7% yield, trailing JEPI by just 1 percentage point. Competitive income without sacrificing too much return. Now for the real question. JEPI's yield advantage is tiny. Just 1% more means an extra $1,000 yearly on a $100,000 portfolio. So here's where we stand. JEPI wins on total returns but carries double the drawdown risk. BKLN dominates risk-adjusted metrics with superior downside protection. The final battle comes down to income and volatility. In plain English, think of dividend yield like couch change. JEPI delivers 8 quarters while BKLN finds 7. Both pay you regularly, but one's slightly more generous with the income it hands over. Now let's put this in perspective. Volatility shows how bumpy your investment ride gets over 5 years. Retirees can't afford wild swings when they need steady income. But wait, there's more to this story. JEPI's 11% volatility over 5 years shows you're getting equity exposure, but without the wild swings typical stocks bring. Here's the thing, though. BKLN's incredibly low 4.4% volatility means you're getting smooth, stable returns, less than half the turbulence you'd see with JEPI. In plain English, volatility's like choosing your ride at the amusement park. JEPI's the thrill-seeker's roller coaster. Loops, drops, wild swings. BKLN, That's the kiddie track. Smooth, predictable, maybe a little boring. Now here's where it gets tricky. JEPI's recent volatility hit 4.6% over 30 days. Those short-term price swings are staying elevated for now. But that's not the whole picture. BKLN's less than 1% volatility over 30 days shows remarkable stability. Your portfolio barely moves even when markets get choppy. Let's see how this plays out. BKLN's rock-steady price action comes from senior loans, while JEPI rides equity volatility for those bigger returns you're chasing. In plain English, JEPI's like riding a stormy ocean. Wild swings, choppy seas. BKLN, that's your calm lake, barely a ripple. These recent patterns aren't flukes. They're exactly what you'll get long-term. Now let's connect the dots. Every basis point you're paying compounds against you. Over decades, those fees can quietly devour a massive chunk of your wealth. But hold on a second. JEPI's fees are pretty reasonable. Just $350 a year on every $100,000 you invest at 0.35% annually. Let's unpack this a bit. BKLN's 0.65% expense ratio is nearly double what JEPI charges. That's a significant drag eating into your returns every year. In plain English, expense ratios are like a tax you can't escape. JEPI charges 35 cents per $100 annually. BKLN takes 65 cents. That 30-cent gap compounds into serious money over decades. Now let's flip the script. JEPI's lower fees mean more money stays in your pocket. BKLN needs stronger performance just to break even with you. But there's a catch. Correlation to the S&P 500 reveals the truth. Are you actually diversified or just holding the same market risk in disguise? Let's get into the weeds here. JEPI's 0.9 correlation to SPY means it's basically moving in lockstep with the S&P 500. Minimal diversification benefit here. Now let's shift gears and look at BKLN's 0.7 correlation gives you better diversification than equity funds, but it's still meaningfully tied to market swings. In plain English, here's the correlation story. JEPI is basically attached to the S&P 500 like dance partners in sync, while BKLN moves more independently, though neither completely breaks formation when markets shift. Let's zoom in on this. Beta tells you if your fund rides the market's waves harder or softer than the index itself does daily. JEPI's 0.6 beta means you're getting just 60% of market swings, less upside when markets soar, but cushioned downside when they crash. Here's where the story takes a turn. BKLN's beta of 0.2 means it barely budges when stocks crash, moving just 20% as much as the market overall. In plain English, think of beta like an amplifier knob for market swings. JEPI turns volatility down to 60%. BKLN dials it way down to 20%. One muffles the chaos, the other practically silences it. BKLN's low beta keeps you insulated from market swings, while JEPI's equity exposure means you're still riding those market waves. So, who wins? JEPI delivers better returns and income, while BKLN offers superior stability and downside protection. Choose based on your needs. In plain English, here's the trade-off in sleep well terms. JEPI swings for bigger payouts but suffers larger losses along the way. BKLN takes the conservative route. Smaller wins, but you'll sleep better at night. Here's where things get revealing. JEPI's offering 60% returns with an 8% yield. If you're cool with 14% drops and moderate volatility, it's worth considering. Now let's put this in perspective. BKLN's sweet spot. You're getting 7% income with bond-like stability, perfect if you can't handle major losses despite paying more. In plain English, think of your portfolio like packing for a road trip. JEPI's your GPS getting you there fast. BKLN's your detailed map for steady navigation. Different tools, same destination, just different routes and speeds. So which fund fits you? JEPI's for moderate investors chasing growth over 5 to 10 years. BKLN's for conservative types prioritizing safety. In plain English, think of it like race cars. JEPI's built for speed when you've got time to chase performance, while BKLN takes the steady line to avoid crashes when you need reliability. Here's the key takeaway. Standard disclaimer here. Do your own research, consult professionals, invest responsibly. Now let's put this in perspective. That's a wrap on our ETF showdown. Hit subscribe for more data-driven fund battles that cut through all the marketing noise.